Over a year ago, I bought into a real estate investment trust by the name of Omega Healthcare that was facing some pretty serious challenges at the time. What the company was experiencing were several tenants being unable to pay their rent, as well as lower than ideal occupancy ratings for the ones that were able to pay their rent. Given the types of properties that this REIT owns, which are skilled nursing homes, as well as the amount of growth this company had for more than 20 years, I made the decision to buy a few $1,000s worth of shares in this company, believing that they were about to make a good rebound after the pandemic. In the year that followed my first purchase into this stock, needless to say, things did not improve as fast as I was hoping. In fact, things appeared to be getting worse for this company as time went on. Those tenants that were struggling to pay their rent still weren't able to pay the rent that they had owed, and occupancy ratings remained pretty mediocre. But probably one of the worst things for an investor is that this REIT for a period of time had a payout ratio that exceeded 100%. This meant the company was paying more money in dividends than it was actually making each quarter. It's obviously a very big issue for any investor because obviously if the payout ratio is exceeding what the company makes, it's going to be impossible for them to not have a dividend cut in the future. During this time, I had doubts as to whether or not I made the right move in investing in this stock, even though it was only a few $1,000s. Back in January, the company announced they had anticipated lower returns in the first quarter of this year and that the dividend payout ratio was going to be stretched even further. The reason for this was because they were in the process of restructuring their agreements with several other tenants who were struggling to pay Omega Healthcare the rent that they were owed. All the while, the dividend yield for OHI was hovering around 8% on the low end and sometimes exceeding even 10%. It was during that time that, although I was questioning my decision to buy this stock, I decided to hold on to it. But then earlier this month, the company announced their first quarter results, which had a mixture of both bad news as well as some optimism about their future going forward. So today I want to address the latest developments with this company since I haven't really talked about OHI for a while. If you're not too familiar, Omega Healthcare is an equity REIT that provides financing and capital to the long-term healthcare industry with a focus on skilled nursing facilities and assisted living facilities. As of March 31st, this company had 906 properties with over 90,000 beds. These properties are managed by 66 different operators and they have almost $10 billion in real estate investments. They're one of the oldest nursing home REITs still in existence, having been launched in 1992, and Omega is also a triple net lease REIT. These are my favorite type of equity REITs because it means that the tenants and not Omega themselves are responsible for covering the cost of maintenance, insurance, and taxes. Their properties cater to a lot of different needs including assisted living, independent living, and traumatic brain injury centers. Between 2001 and 2020, the share price of OHI had grown by more than 2,000%, and after resuming dividend payments in 2004, the company had consistently grown their dividend almost every year for 15 years. After a difficult late 90s and early 2000s, it appeared this company had finally found a successful path for continuous growth going forward. But then in 2020, the pandemic happened as we all know and it caused a lot of chaos, and nursing homes were one of the most heavily impacted. In fact, most medical REITs got destroyed during this period, with some still struggling to recover to their pre-pandemic days, including Medical Properties Trust, Sabra Health, and LTC Properties still lagging behind while a number of REITs have recovered. What happened to Omega Healthcare during this time was pretty traumatic for them. Occupancy ratings in their nursing homes fell 13% between February of 2020 and January of 2021. It also resulted in a huge shortage of skilled workers in these homes since a lot of people didn't want to work under these stressful conditions. That increased costs for the operators of these properties since they had to offer more to convince people to work for them. In response, there was some pandemic relief to these businesses, but the amount of support they received varied from state to state. As of right now, there's still several operators that control Omega's properties who are still facing hardships. Some of those include Maplewood Senior Living, LaVie, and Agemo. They're currently in the process of negotiating deals with Omega in order to help them return to a state of being able to pay rent again. One of the conditions being negotiated includes removing rent escalators for a period of time. This means that Omega will agree to not increase their rent for a number of years to help relieve some of the stress these operators are facing. Some are discussing the possibility of selling some of their properties and allowing a certain percentage of their rent to be deferred. It should be noted that despite all of this, with everything going on with the pandemic and some of their operators not being able to pay rent, OHI has never cut their dividend. Throughout the entirety of this storm, the management team hasn't reduced their distributions to shareholders, which is something that I think surprised a lot of people, given just how many challenges they're facing. Finally, on May 2nd, the company did release their first quarter results, and it resulted in a lot of movement for OHI's share price. In their earnings report, Omega Healthcare announced they had received roughly 60 cents per share in income, which is a sizable drop from the previous quarter as well as from 1 year ago. The reason for this was due to the restructuring that Omega is currently doing with some of their operators. Along with these results, Omega Healthcare also declared a dividend distribution of 67 cents per share. This gives their stock a payout ratio of 112%. So definitely not good news for this company, although they did warn us back in January to expect these kind of results. But probably the most important information was given during Omega's earnings call. Taylor Pickett, who's the company's CEO, gave some really crucial updates on the situation. Quote, as expected, our first quarter per share funds available for distribution of 60 cents per share was less than our quarterly dividend of 67 cents per share, resulting in a dividend payout ratio of 112%. We expect that the dividend payout ratio will rapidly improve as Agemo has resumed paying quarterly rent and interest on April 1st. In short, although we are not yet providing full-year guidance, we anticipate we will return to a payout ratio under 100% in Q3 with a path to return to a normalized payout ratio in the high 80s to the low 90s in 2024. This outlook caused their share price to jump about 10% in a week, and although it definitely is good news that the management team is optimistic and they have a plan, it's still no guarantee that the company is going to be able to make it. Anything could happen in the remainder of the year, but up to this point, it's been really impressive that they haven't had to cut their dividend. They managed to hold on to that 67-cent distribution, which shows the company really does care about their investors. The fact that Agemo is going to start paying rent again should really help them out, considering Pickett said that this is going to rapidly improve their payout ratio. With this news, it does make me feel a little more confident in being an Omega shareholder, and hopefully we are going to make it out of this without a dividend reduction. There is one more important issue that's concerning, which is the amount of debt that Omega has that's about to mature. In their latest investor presentation, we can see $350 million in debt is going to expire later this year in August. With interest rates being as high as they currently are, this is going to make adding new debt to their balance sheet a lot more expensive for them. This is one of my biggest concerns for Omega going forward. They also claim that they have a really strong balance sheet in their earnings report, but it was honestly kind of a generic statement. Their CFO said, our balance sheet continues to remain strong thanks to the steps we've taken at the start of the pandemic to further improve our liquidity, capital stack, maturity ladder, and help protect our overall cost of debt. In summary, based on the earnings report that just came out, I think the darkest days for Omega Healthcare are now in the rearview mirror. With the exception of reinvesting my dividends, I haven't bought any shares of this company for almost a year now. I'm siding with the management team and I'm planning on buying more shares of this stock soon. The case for Omega continues to be strong when considering the potential they have for future growth. You can see that more patients are discharged to skilled nursing facilities than to any other type of facility. Although home care is far more ideal than moving to an SNF, it's simply not a possibility for most Americans. Since these people are no longer working, what happens to most people in this situation is that they have to sell their homes and use the proceeds to move into an SNF. Holding onto your home and paying for home healthcare isn't affordable, which is why SNFs aren't going away anytime soon. As the US population continues to age, more of these facilities are going to be needed for these people. And right now, Omega is the largest owner of these skilled nursing facilities in America, yet they only own 5% of the market. This gives them a great opportunity to further expand their property portfolio once the recession is over. They claim their goal is to double in size by the year 2033, which is pretty ambitious. In the meantime though, I'll keep collecting my massive dividends, which is currently yielding over 9%. If you were curious on my opinion, I think OHI is a safer investment right now than MPW, which I'm also a shareholder of. But like I said, as optimistic as Omega's board is about sustaining that dividend, it still cannot be guaranteed that they'll make it out of this without a cut. But so far, the future appears to be much brighter for them. With that being said, that's going to wrap up today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.